Hello and welcome back to the ROI channel on the Maverick Life. And today I'm going to just go over a macro update, see where we are in a bigger picture perspective, and how I'm looking to protect some downside coming into what I think, if not 2024, 2025 might have some really rough moments for equities. So I've got my thinking hat on. You know what that means. It's time to get into it. Disclaimer, nothing I say is investment advice or advice of any kind. It's just me documenting my thoughts, and you crazy people apparently want to listen to them. If you want to listen to them in different forms, you can follow me on Twitter. Please do like and subscribe to the channel. It greatly helps the algorithm. And then, of course, eToro, if you want to add me to a watch list and see how the portfolio is doing there. So let's check in with what is really the benchmark for equities around the world, which is the US stock market as represented by the S&P 500. So we are at basically historic highs at the moment, both in terms of the price, both in terms of the RSI indicator here. You can see we're well into overbought territory down the bottom, which means that there is more and more momentum buying these things. It's come on the back of Jerome Powell announcing that there will be no more rate hikes in the foreseeable future, and quite possibly 2 to even 3 cuts this year being priced in by the market. So you've got to ask yourself, okay, well, on the one hand, you have some interest rate cuts. People believe that loosens some credit conditions and leads people to want to go further out the risk curve because they're not being compensated as much to sit in cash. And whilst that's true, we also need to ask ourselves why they would feel the need to cut interest rates in the first place. And generally speaking, that usually happens when bad things happen. So if we have an earnings recession, a multiple contraction, then we would start to see this number drop off, even in the face of an interest rate cut. So we've got 2 scenarios when it comes to rates, and I try not to think about rates, but over the short term, they are extremely influential. Obviously, up, down, or sideways, mainly up or down is what's going to concern people. I'm trying to position myself so that if rates remain where they are, and so you get an effective real rate increase, so not nominal, but if we're talking real rates, we get an increase that you would assume be bearish equities. There'd be a little bit of a demand pullback for those types of stocks. But you would think to yourself, well, what would cause inflation? What would cause inflation to be such that the Fed would want to hike or keep rates? And you would see that coming through the commodity sector. So owning commodities in that case, keeping it very, very simplistic, would be a good position to be. So the sentiment over the last month or so has been, okay, rate hikes or effective rate hikes would be bearish for commodity demand. But what would that really change in terms of the supply side? And I believe it wouldn't really change much. But already under invested, if you have a higher cost of capital, if anything, it's going to further constrict supply. So from a financial perspective, you may see a longer period than you anticipated before you start to see equity prices rise in the commodity sector. But really, at the end of the day, the big theme has always been a lack of supply on growing demand. Maybe demand softens a little bit in the face of hiking rates. And obviously, that won't change the supply picture because there will be no incentive for capital to be expended to increase the supply of those certain commodities. And as I've mentioned before, we would look at the rates only having been hiked in the face of a rising inflationary environment, and what would cause that inflation to be reported as rising, and increase in the input cost to everything. So travel, transport, and the raw goods, also known as commodities. So let's say rates are cut. What would happen there? Well, if we had a real slowdown in terms of economic activity, the Fed would come to the rescue and want to cut rates to try and stimulate the economy again. Traditionally, that's actually been bearish equities, although people see it as a sigh of relief in the short term. If you look at, you've had a sharp rate hiking cycle followed by slight pause and then the pivot. If you count out roughly 200 days on average, you actually had a drawdown in the overall stock market of 24%. And that's because, again, it speaks to what I'm saying here about the rates being cut as a kind of a knee-jerk reaction by the policymakers. And so what would cause them to have that reaction? Well, you would have some hard economic times, or at least perceived hard economic times for broad stocks or equities in general. Then, of course, if we have a loosening up of credit conditions of rates, that will allow a little bit more leeway for demand to stimulate through the economy, and that will stimulate demand for commodities themselves. Hence why, and many other reasons why I think the commodities still are the place to be. The market's pricing in disinflation. That may or may not happen. I think my personal take is it's more likely to be surprising on the upside than people think. I'm positioned well for rate cuts for a number of ways. It will stimulate demand for commodities, as I mentioned, particularly in emerging markets, in addition to which you would expect to see the DXY or the US dollar index roll over a little bit. If that softens, and because investors aren't getting rewarded as much for having US dollar denominated financial assets, they would start to look elsewhere in terms of where to put their investment dollars. You have a slight decrease, all else being equal, in dollar demand, and that would start to flow into, I believe, the likes of Latin America, particularly Brazil, Colombia, and Mexico. Hikes or real rate increases via the Fed would occur via no action. How to play it, that's what I'm thinking of. So what's expensive at the moment? It's easy to get caught up in all this. But at the end of the day, we're trying to buy low and sell high. Or at the start of the presentation, you'll see I'm trying to sell high and buy low. If we look at the PE ratio for the S&P, so you take the S&P and you say, how much am I paying per dollar of earnings? At the moment, you're looking at $26.55 for every dollar of earnings. And by the way, this is unexpected negative growth. Okay, everyone's going to say, oh, well, you got all this AI and tech that's going to provide earnings growth. Well, you need a lot of earnings growth to justify that kind of multiple. And that's just not the kind of investor that I am. I like to pay low multiples, discounts to asset value, because it's just easier. I just have a lower hurdle rate to get my money back and then to make returns on that capital. If you look at the CAPE ratio, I didn't put it in as another chart because there'll be lots of charts otherwise. The CAPE ratio at the moment, 33 times. So that's if you just adjust the PE for cyclically adjusted inflation. Okay, so real earnings, let's call it. That comes at a median of 15, call it 16 times earnings. So we're a long way above where the median valuation has been historically. The issue I have with that is if you look down here, it goes all the way back to December in like 1917 when they calculate the median. I've truncated the chart here so that we can just keep it to a relative period of time after the dollar system changed. And so you could argue, okay, since then, you would expect to pay a little bit more than 16 times. I don't know. I think 16 times is a reasonable median. Another thing I've just pointed out in here is that if you look at the red X that I've marked, that's July 2007, where you had Fed funds rate at 5.26, which is roughly where they are today. And you had a US Treasury touching, a 10-year note, I should say, touching 5% also. So similar to where we are today. What was the market willing to pay back then? So at that time, the market was paying $18 per dollar of earnings. And at the moment, we're still above that at 26.5. So you've got to ask yourself, are we more likely to grow our way out of that? I personally don't believe so. What's the fiscal situation of the US? It's gotten a lot worse since then. We had the GFC, then we had COVID. So we've had all this money printing. We've had deficit spending in the Congress. And so I think it's getting harder and harder to justify these valuations, saying that there's going to be improvements in real GDP and real productivity. So the funds rates, the cost of funding this whole thing. Here you can see the blue line, dark blue line is the Fed funds rate. Yellow line is a US 10-year note. That's important because generally that's what's used as a discount rate or an alternative rate that investors look at. So anything you want to invest in, you would want it to be higher than the so-called risk-free rate, which at the moment of recording is it's basically 4%, we'll call it. As you can see, you had these historic rate hikes, plateau, sharp drop, rate hike, plateau, sharp drop. This speaks to what I was saying before about when the Fed cuts rates. After that, you start to have you start to really worry. And the reason is, if you look here, 2000, we had dot-com bust. Then we had the Fed pause and drop after the financial crisis. Same deal happened with COVID. We have way overshot the mark with the most aggressive rate hikes seen in recent history anyway, in terms of the velocity. And so what are we going to see in the next 200 days? Are we going to see another, on average, you'd expect a 25% decline in the broad index. Earnings yield. So you're getting 3.7% yield if you just own the S&P. That's almost half of where it has been historically, median valuation of around 6.5%. And you got to stop and think about this logically. You think, well, would I take all the risks in these stocks and receive an earnings yield of 3.7%? Or would I just buy the damn like T-bill, which at the moment is paying over 5%? So if you lend money to the US government risk-free, in inverted commas, 60 to 90 days, you're getting your money back and you're getting paid over 5% for that. It doesn't make any sense the way that I look at things. Earnings. So if I were doing one of my normal company valuations, how would I look at this? How would I do a quick and dirty, rough, back of the envelope valuation? Well, I'd take the earnings, I'd put what I think is a reasonable multiple, and I get a price estimate. That would be the first thing I'd do. So let me take the earnings of the S&P, 183.8. If we use the historic median of 15 times valuation, we would expect a target price for the index to be around $2,745. Now that is that's a long way from where we are today. That's basically about half of where we stand. So for us to get back to that, it would indicate a drop of 44% would be necessary to come back in line with that valuation thesis or way of thinking. Similar deal. If you said, okay, but I want to apply a PE of 20, fine. That still implies that 25% drop. So any which way I personally look at it, I think that the broad index is very expensive in the US. And again, to hammer the point home, 1 month bills paying 5.36% as of this morning. A quick note, lots of people have spoken about this, so I'm not going to go into it in any real depth. But what is the S&P 500 really? Is it a broad sector diversification? Well, not really. I mean, it's basically tech stocks. Here you've got 26.7% of the index, at least when this graphic was made up last year, belonging to the tech sector. Then you argue, well, what about financials? Some of those could probably overlap in that particular sector. Amazon, is that a tech company? Certainly where it makes most of its money. What about Tesla? I know it's a car company, but it's really the technology behind that. So an awful lot of that does come or could be considered loosely, at least, as part of the tech industry. And why have I been focusing on industrial materials, commodities, and energy in particular? Well, it's such a small percent of the S&P. Traditionally, it's been a lot higher than that, almost 3 times that weighting, and in bull markets 4 to 5 times that weighting is not unheard of. Commodities to equity, let's look at it relatively. So do I buy A, do I buy B? Well, which one's relatively expensive, which one's relatively cheap? Simple stuff. So we use a ratio when in this particular very broad commodities index versus the S&P. When the chart is high, you are looking at expensive commodities relative to general stocks, and the inverse is also true. So we hit historic lows or recent historic lows in COVID. That makes sense. And then we've had this little run up and then we're back down. We are really, if you measure commodities against the S&P, they look extremely cheap, regardless of what's happened over the last 4 years. This is a good little graphic, and it's essentially providing the same ratio. It just gives a little bit more of a historic background. So if you go on Visual Capitalist, it gives a few reasons as to why the movements occurred in the charts as they did. So a good little visual there. So what am I doing on the sell side? Selling high, buying low. Selling high valuation selling high volatility. In particular, at the moment, I'm selling some out of the money credit spreads on the SPY. That's just an ETF that's a little bit cheaper that tracks the SPX, which is the SP 500. This is an insurance bet. Really, I'm betting that the market will not rise above this sort of 500 to 520 range. Okay. I'm betting it doesn't go above 5,000 for the S&P. It will be 500 in the SPY by the end of the year. And I've reinsured that. So if it does rise above that, I'm covered. I cover all this stuff in the Maverick Life, where I share my options trade with members. So what happens here? Well, I receive some credit, so I get paid $1,000 per one lot, and I have $917 at risk. Okay, so if the SPY were to finish up the end of the year over 520, and then I've lost in my insurance bet. Essentially, that's the easiest way to look at it. My best case scenario is that it stays below 510, which is the technical break even of when the contract is in the money, and plus the amount that I've received as compensation. Think of it simply: if the S&P is below 510, then I keep all of this $1,000. Okay, I keep all that $1,083. Okay, so I got a decent chance of that happening, and I could also roll that out if I decided to. So I think, given where we are, I think we are at historically high valuations. My bias is that I think we're going to have either a slow grind down, or at least a steady decline in the S&P valuation. And so I'd like to make some profit off that. If I want to be a bit more aggressive, what else could I do? Well, I can buy various instruments, or I can take this capital and I can buy cheap volatility. So I'm selling what's high, the valuation of the S&P 500, and I'm buying what I personally believe is cheap, which is some out of the money VIX calls and call spreads. So the VIX is a measure of the volatility of the index we just looked at. And when things go haywire, when you have sharp price movements, this thing goes up. And when things are steady, this thing goes down. And it just stays down for long periods, and then traditionally has a boop when you have a crisis, and then it goes down. So the trick is to look when it's been at its lowest, and you are essentially making a bet. So this is not an investment by any means. What will happen, what the beauty of this is, if we have a downside event and my stock holdings drop in value because the whole stock market selling off and people are throwing the baby out with the bathwater, etc., these things will rise in value. So I'll be able to cash them in. The idea being I take that profit and I'll be able to buy back in the companies that I really like at very low levels. So I'll make some profit. It's an advanced and it's speculative and it's an aggressive hedge. Most of the time, I just simply hold cash if I want to have some opportunities. So this is not applicable for everyone. And for God's sake, if you're not familiar with this, don't even worry about it. It's just something that I thought I might share because some people may find it interesting. Now, this is the cost of, I think, 30 lots, so 3,100 shares, 30 contracts. You'll notice here that this is roughly the same amount of money it's going to cost me as what I received by selling the credit spread. So essentially, I'm taking two views on the same outcome. I'm expecting that the equity index is going to drop. I have more margin for error by selling the out of the money call spread, and I have a more aggressive, higher upside version by buying these fellas here that do expire earlier. So if we get the data coming in February, March, and we get a sell-off, that's what I'm playing for. Okay. If things go to plan, well, there are two options. So I can cash in on both, and the S&P it can drop heavily, and the VIX can rise above $20 before March. I cash in on this fella. I make a 14x. That would be nice. Not saying it's going to happen. And that would mean that I made 14 grand essentially for free, because providing that the S&P doesn't recover miraculously by the end of the year, I received the $1,000 from selling the credit spread, and I just take that same money and I use it to have these free call options on the VIX, and that would be nice. I'd get a free 14 grand by March for selling one credit spread. So getting $1,000 and just taking that $1,000 and putting it over here in the VIX calls. Obviously, that's only one side of the equation. It's only one outcome. If the VIX doesn't move, I lose all this and the contract expires worthless. I will end the year break even if the S&P does not rise above the $500 or 510 mark, which is my break even. So I can break even that way. I can lose money. So I can lose all this money if the bull call doesn't pay off, if the VIX doesn't rise above 20 by March, and the stock market just grinds higher very slowly by the end of the year above where I've sold the credits. I would lose 900 here and I'd lose 900 there. So total consideration of $1,800. And so you got to be aware of that. I think the probabilities and the risk reward are in my favor. That's why I'm doing this. You can scale this up or down according to your needs. So I sold one credit spread. If you got heaps of money to cover that, you could sell 100 of them and get, 100 grand. And then you could put into here, you could do whatever you want. This is just the lowest scalable idea that you can adjust according to your balance and your needs. This is what I'm talking about, the VIX. So I'm buying here at a very historic low. RSI suggests momentum is sort of bottoming out. I would suggest the momentum is, or the probability is more to the upside. It doesn't mean it's going to happen, but I get paid pretty well, even in the unlikely event that it spikes up to 20 and 20 level by March. So when you see these big spikes, that's generally when bad stuff happens. So you have a GFC event, you have COVID, and huge price changes. That's what causes the VIX to move around. So volatility is cheap in certain sectors, but if you don't care about options, if you just want to buy something and go to sleep, the way that I look at it anyway is what's the lowest price paid for earnings. And again, it's still the energy sector. Okay. So you're looking at $9.98 for next year's dollars worth of earnings across the whole sector versus technology, you're paying 25, and the S&P you're paying 26, as you saw before. Price to free cash, you're getting about a 12.5% free cash flow yield versus nothing in sort of tech and real estate. Yeah, it's less than 3 in tech. So this is the way I'm thinking about it, guys. Like, you look at the growth rate. Well, that's the argument for tech. But if you look at tech's growth rate over the past 5 years in their earnings, 18%, energy's outpaced that, 26%. And I know COVID affected that disproportionately, but I just think it's another point that needs to be made. People are expecting tech growth to be 12.5% over the next 5 years. I don't know. How much more market saturation can Apple get? Can Microsoft get? I'm not sure. But I believe that only a 1% earnings growth for the entire energy sector, with everything we've got going on in terms of global rebuilding, global population growth, demand growth, I'm going to take the other side of that bet and say it's going to be a lot higher. That's it. Hope you enjoyed that. Something a little different. Leave your comments in the comment section, and I look forward to catching up with you in another video shortly. Take care.